Once again, welcome back, guys. Today we are starting with uh, wealth management for working professionals, series number 10. Last time we covered something related to behavioral finance. So, once again, we will recap before we start with the new things. So, as we said, Charlie Munger had been the pioneer in this particular aspect, whereas most of the theoretical work or experimental work is done by Professor Richard Thaler from University of Chicago, and most of the concepts which are being discussed is mostly based on experiments conducted by Professor Thaler. So last time we have discussed something about overconfidence. Overconfidence is nothing but a mistaken or error in judgment while making our own assessment. And we tend to overassess our own skills as well as our own abilities. And that's where we make all the mistake. And most often, this is one of the reason why our whatever predictions or whatever our analysis or assessment goes wrong. So it is also, because of something called as an overreaction bias. Overreaction bias and overconfidence are very much interlinked, because what we tend to do is why we become overconfident is only because we tend to extrapolate whatever the latest information we have seen, and we tend to think that we have seen some signal about future based on extrapolating the current or latest information, and assuming that whatever the latest information is going to affect or influence your future, whereas we are not taking into account all those extraneous factors or internal factors which are affecting a particular company or a particular decision. So that is the tendency to make the quick reaction or quick overreaction. And people, it is found that people tend to overreact to negative news or a bad news than to a good or positive news. So overreaction bias, if you want to overcome any of these positive things, attributes to be more dominant, it has to be twice or even more than twice that of negative news. So only then people tend to see, and this particular bias or whatever the so-called overreaction bias is said to be investors' myopia, because we fail to see the long picture, and instead we tend to be very myoscopic. So indeed, this overreaction accentuates your overconfidence. So both are interlinked. So this is the first thing which we have learned. Then it is all stemming out of our own innate behavior. Like we all tend to have loss aversion. And indeed, behavior is found that it is the pain of loss is far greater than the enjoyment of a gain. So whenever there is a bet, that even bet where with people giving an option, one riskier option, the other is non-risky option, though the returns for a risky option is much high. It is observed that most often people tend to take a very safe bet rather than trying for a risky thing. So there were certain experiments which were conducted. We discussed at length in the previous session. So there is no need to recap it again. It's basically a recap session. So I won't like to reiterate and redo it again and again. So now another one more thing comes into account is the mental accounting. We tend to account for different monies to different scenarios. We have discussed about the lost money and the gambling. And when it is our money, we tend to be very conservative. We tend to ensure that we get maximum out of it and we don't lose our money. When it comes to other people's money, it may be your own kids, your own wife, or somebody, your own relatives, or anybody else. So they tend to totally behave in a different way because it's not their money or our money. So we tend to take too much of risk. So this mental accounting also is one of the biases which we tend to see when it comes to behavior of various individuals. So the next thing is risk tolerance. Again, this mental accounting also can be seen with fund managers. Some of the fund managers, maybe some try to own their fund. They assume that whatever the fund they are managing is almost akin to their own funds rather than somebody else's fund. Then the second option, which is like if it is other people's money, naturally they don't have much of a stake, and where with the given information and circumstances, if they are making their own investment, they tend to put in a much better thing based on the information which they get compared to what it is for the others. So this behavior is seen, and then the next, very important aspect is risk tolerance. Risk tolerance is basically a behavior which, makes us to be risk averse, and generally it is found with two demographic factors. One is gender and the age, and the old people tend to be more risk averse compared to the young, and similarly, females tend to be more risk averse compared to the males. So this also explains why we tend to, fail or behave differently for different kind of a things, despite having the same information. So next is the herd mindset. Majority of the people tend to conform to a herd, or rather, they want to be a conformist rather than taking their own assessment, analysis, and then take their own independent decisions. Most often, people find themselves to be more comfortable being with a part of a herd. This herd behavior, you find it in stock market, be it the so-called your bull run or bear run, a bull and bear or whatever the so-called emotional things like greed and fear factors, they all stem from this particular herd behavior. Then there is another one particular aspect which comes into play is emotional gap. So whenever we are in an extreme state of emotions like fear, anxiety, or excitement, that is the time when we should not take any decisions, because we are not in the best frame of mind to apply rationality, because our emotions tend to cloud our cognitive abilities or rational thinking, so we tend to make mistakes. So better avoid when we are in the state of emotions, so better avoid it. Then the next aspect is like anchoring aspect, like we mentally fix certain allocations for certain kind of opportunities. Say we have allocated for risk and so-called uh, so the so-called equities as well as the risk-free bonds. We have made fixed allocations for large cap, small cap, and mid cap, and for say debt equities, debt. So naturally, once we fix it, irrespective of the kind of opportunities that will be thrown to us, we tend not to, change our position. This is one more bias. So as an investor, you should be more flexible compared to others. And then the next is self-attribution. We always, attribute. This is one of the factors majorly responsible for the so-called overconfidence and overreaction biases. So we always tend to attribute, our overconfidence about our own knowledge or skill, and then we always feel that we have a knack to find out the best area, because once or twice by chance we happen to have predicted something right. So that belief in our own self or our own abilities tend to increase, that lead to a lot of making mistakes rather than making a proper rational approach or rational optimistic approach. So then we talked in depth about confirmation bias. Confirmation bias is attributed to almost everybody. We all tend to make a hypothesis or an assessment about our own, say, hypothesis about a specific investment or a specific thing. So we tend to believe in that irrespective mountains of evidence is being against it. We tend to believe one evidence which is, bolt in the blue, or something, out of mountains, we find one small information. So we tend to confirm our hypothesis based on a small evidence, which is, however, that information or assessment is totally flawed, but still we believe because we already made and assessment. So we tend to go with this bias. This is one more which is affecting our own investments. Then another bias, which is called as experiential bias or recency bias. So what we tend to do is we tend to equate everything to the experience we have undergone. Suppose we had a very bad experience with a particular investment, say stocks. We lost money due to, say, we have coincided our investment with say a kind of a financial crisis of 2008 or 9. So what generally we tend to believe is, yes, markets are very risky, and we most often we might have ended up losing a lot of money, including myself. So naturally, we tend to go by that bias, and we shun off the opportunities otherwise available, which will give you best of the best returns. So this is one more bias, which we all tend to go for. Anyway, loss aversion is already discussed. Another thing is familiarity bias. Every person has certain areas of familiarity, like areas of competence. We tend to be very familiar about an industry. Say, if you are into IT or an IT background, you tend to have a lot of information, knowledge about IT. And most often, majority of the picks you tend to choose is from the IT. And then, though there are other opportunities from other sectors, we tend to ignore it because something which is unknown. Like there is a saying in English, known devil is better than an unknown angel. So we tend to go with something which we are familiar with rather than with we are not at all familiar with. So in the process, you lose a lot of investment. So based on a study conducted in United States of America, US markets, so it was found that due to this particular familiarity biases, most of the equity mutual fund investor underperformed S&P because of this particular bias. Similarly with when it comes to fixed income investor. So they tend to fail because of this bias. So now we are starting with the new area which we will be discussing in depth. That is fear of regret. Uh, Before we start, I'll give a small gap. Welcome back. Now we will be dealing in depth into fear of regret. Fear of regret is basically or simply regret theory deals with emotional reaction people experience after realizing they have made an error in judgment. Faced with the prospect of selling a stock, investors become emotionally affected by the price at which they have purchased the stock. So they avoid selling it as a way to avoid the regret of having made a bad investment as well as embarrassing of reporting a loss. We all hate to be wrong, don't we? Naturally, we hate to be wrong. So this is a very important and paramount theory. Many a times, we tend to take decisions where we later realize that yes, we made a mistake in taking that particular stock, which they assume it to be bad decision. So what is our reaction? The reaction is nobody want to book losses. Suppose that particular stock is not doing well as of now, because of which, say you are bleeding somewhere around 15 or 20% in losses. So what is your reaction? Reaction of an average investor is they don't want to book loss or repent for doing regret a bad investment. Rather, what do they do is they wait for some more time to ensure that the company make good whatever the losses right now they are into. So we will wait for a time where we will recover all the losses or enter into profits or book some profit. So this is in thing, and many a times we don't tend to, attribute any kind of uh, rationality to this particular thing. Instead, we tend to leave it to chance. So what if, there are two kind of questions when we are faced with such kind of situation. Should we liquidate it and book some losses and then take a right kind of a decision, or wait? So when waiting, you have two options. One is you check whether this particular company is doing well. A rational decision maker, if they commit mistake, what they do is, it happened even with me. I I was, without looking at the company's profile based on some information given in some website. I just blindly taken two, three companies which I thought they're all very small cap companies. Maybe they have shortly, within very less time, we have registered some 300 percentage gain. I thought, yes, this is in the momentum phase, so this bull run may last a little longer, and that is where I can make money. So by the time, all of a sudden, after 2, 3 days, I have seen one of the stock booked some 90% losses. Immediately I reacted, and then I took all those, companies where I have invested into it. I've gone through their balance sheet, all that stuff. Then I understood, yes, I made a mistake. Immediately I sold all losses in all those three or four companies. Then I re-entered into other companies which are in Fortune 500 companies. So that is how, I took a decision. Most often what we do is, this is my one of the latest behavior when it comes to the past. In the past, there was a situation, especially in 2007, 2008, December 2007 and 2008 Jan. So that was a time stock was at Indian stocks were at all-time highs, 21,000 Sensex, 22,000. So it struck 22,000 somewhere in January. Then came the crash because of in Indians scenario, it was because of IPO of Reliance Petroleum. Sorry, Reliance Power. That was an IPO which is oversubscribed. Most of the money liquidity in the market was put into, everybody put money into it. So many of these people, because the capital blockage was for around 3 or 4 months till, the uh, shares are allotted. During that period, many of the people, they failed to sell their stocks because they were anticipating, they used to rotate whatever the funds, and then that's how they wanted to make money. But most of these people, they failed. So since there are many sellers rather than buyers into it, so the stock market started tumbling and collapsing. So that is the time, almost just few days before that, maybe 5 to 10 days before, I invested into many penny stocks, small stocks which have given almost 50% profit. So that was the time when I waited, and then I thought, yes, they will let it give me 100% profit. So that is the time I'll be booking profits and coming out. So that 100 never came, and then stock started tumbling, and I waited for 3 years till I booked a loss of almost 3.5 lakhs, which is somewhere around 97 or 98% I have to book losses, and then come out in the process. Many of the companies have lost. They were totally out from the market. So I lost even that money also. So that way, this is how, we tend to behave. And there is a saying by Peter Lynch, one of the very famous investor. So he is one of the person akin to the so-called Warren Buffett. So he is also highly successful, and he always beat the market along with Buffett and others. So that guy, he said that this particular behavior of us, the especially, sticking to the loss making companies while selling or booking profits in profit making or profit giving companies or good companies. So this particular thing, he said that it is just like cutting the flowers and watering the weeds. So what we tend is, we steadfastly cling on to loss-making companies till we lose entire of the money, and before we realize we are losing, it's too late. So that is why this fear of regret is one more bias which is at play when people put money into wrong kind of a stock. They don't want to feel that they have taken a a decision that may give them regret in future to come because of some, error in judgment. So rather than embarrassing or embarrassment due to reporting a loss, they tend to wait till they make it. Many times it may not come. So better be wary of it. What investors should really ask themselves when contemplating selling a stock is, what are the consequences of repeating the same purchase if the security were already liquidated, and would I invest in it again? If the answer is no, it's time to sell. Otherwise, the result is regret in buying a losing stock and regret of not selling when it become clear that the poor investment decision was made, and a vicious cycle ensues uh, where avoiding regret leads to more regret. Regret theory can hold true for investors when they discover the stock they had only considered buying has increased in value. Some investors avoid the possibility of feeling this regret by following conventional wisdom and buying only stock that everyone else is buying, rationalizing their decision with everyone else is doing it. So actually, this is again one more what we have learned. Like many people tend to see whatever most people invest. That is what you know. It's wise to put money into, but stock markets are not that way. You may take the right kind of a stock but at a bad prices, or bad stock at right prices. So everything, it all depends, it depends on the timing rather than identifying the stock. So what I suggest investor is, always whenever you purchase any great stock, purchase it at a fair levels, or fair when the market is giving an attractive price, especially when it falls. We tend to see most often, like once in a while, maybe once in a month or few times in a year, you find stocks tumbling down. That is the time when you need to invest. That is time when you can. And right now, recently, there is, Reliance coming up with 1:1 bonus issue. So that is the time. Till now, my in portfolio investment into Reliance is very low. Since they are offering me extra bonus share, now I wanted to put money into, because I'll gain extra shares free of cost. So this will give me, more free shares, and that will help me, accumulate more amount of shares. And in any case, more number of shares will always be better for you. And when they issue any bonus, the value of the stock will suddenly collapse. We tend to think that the value has reduced. It's not the reduction in the value, basically, because there is a if extra shares which are entering into the market. Basically, they are all free shares. So the price of the company tend to fall by half if it is 1:1. Similarly, whenever there is a split, say a 10 rupee stock is split into 5 rupee stock, suddenly you find a decline in value by 50%. And most often people tend to purchase thinking that it became cheap. That's not, it didn't become cheap. It is because of the splits and bonus shares, the valuation has changed. So the valuation maybe again maybe a little expensive also, because people have a knack or a habit of seeing that as a fall in price, sudden fall in price, and then without knowing the reason behind it, they tend to jump and put money and then increase the actual valuation. So you have to be very, very careful while choosing picking up stocks. And conventional wisdom says you purchase stock when they are cheap and sell it when they are expensive. So oddly enough, many people feel much embarrassed about losing money on a popular stock than half the world owns, than losing on an unknown or unpopular stock. So, so this is one more very tricky thing, like which I faced of late with from people, uh, whom I have come across. Like some people keep saying that we have purchased blue chip companies XYZ at a very high price. Is it, worth it? And strangely enough, sometimes they sell it and then They regret more than, selling a company which is unpopular or unknown stock, even at a much lesser, much, you can say the percentage loss is much lesser than the so-called popular stock. So these are some of the fear of regret, some of the behavioral aspects at play. So you have to be very wary and handy, and be wary about these kind of things. Then comes is another aspect and a very important, powerful theory is the prospect theory and loss aversion. Both are interlinked. So it's a very interesting kind of a theory. It doesn't take a neurosurgeon to know that people prefer a sure investment return to an uncertain one. We want to get paid for taking on an extra risk. That's pretty reasonable. Here is a strange part. Prospect theory suggests people express a different degree of emotions towards gains than towards losses. Individuals are more stressed by prospective losses than happy from equal gains. This we have already discussed. According to the prospect theory, it always says that people have different degree of emotions towards both gains as well as losses. On one hand, the loss is anything negative is we tend to overreact. We tend to put under the microscope, whereas many a times we ignore whatever the gains we get. So this is the prospect theory at operation. So always, be wary of this particular loss aversion and then behavior, and you have to be equanimous. Equanimous with both the loss and profit. Only then you can make a much better decision. And I have seen many people, whenever you come across people, if you see their portfolio will be doing excellently, outstandingly well, whereas they keep on grousing about one or two stocks which are giving losses. If you see, even the best investors like Warren Buffett, there may be many within that particular portfolio which are loss making, and in none of the cases, usually, all every stock will be giving you positive things. See, what is important to see is the overall gain. If your overall gain is decent, then you are doing better compared to the market or whatever. So what is best to go through is something called as your so-called alpha. Alpha is basically difference between what the performance between your portfolio and the market indicators. I'll just show you for better perspective. I'll just show you how I monitor and track my profits. Uh, I everyday basis I do this diligently. If you see this, so I just put it to this side. Shit. So this is how I track my so-called portfolio. So this is my portfolio at the beginning, and monthly, even daily also I monitor. If you see the other side, this is a daily statement. So every day since April 8th, April 2024, I have started, tracking all my portfolio gains, how much, what is the gain which I am getting, and what is the Sensex value, and what is the percentage gain. I just only look into percentage gain because the portfolio keep on changing. You keep on adding and subtracting few of the stocks, so that value part will keep changing. Whereas what is constant is a change percentage. Change is what is more important. You just need to track it with market indicators. So what I look into, or what I tend to benchmark with is the indicators, market indicators. One is market indices Sensex, then Nifty, then CNX mid cap, and then BSE small cap. So all the large, mid, and small cap indicators are being tested. This is how, because my entire portfolio is a mix of all three. So I try to benchmark with all three indicators, and then this is where the alpha. Alpha is nothing but my performance vis-a-vis Sensex, Nifty, CNS mid cap, and then BSE small cap. So this is how I keep on monitoring a daily basis, because daily there will be a lot of churn. So what I do is, I generally tend to again redo it with something like, monthly. So every month I tend to do, and then say, and later I just started since April 2024. So I'll be doing it for the year as well. So if you see this, this is my performance, alpha performance vis-a-vis Sensex, Nifty, mid cap, and then this is where I tend to look into where exactly I made a mistake. And this big dip is because I have invested most of the money into the so-called uh, a lot of, debt funds, debt mutual fund. They don't give you any returns. Whatever returns is hardly 0.1%, 0.5 percentage in a month. So now I have reduced most of them except two. Still, I'm holding some debt. So that is the reason why there is a drag down compared to, the previous months. So anyway, I'm again, I what I do is I assess my entire of the stocks based on, mutual fund and stock. This is mutual fund. I'll show you for my stocks also. Stocks is this. Stock is also similarly. I'm just putting my, stocks into this everyday basis. I keep on doing the same thing, alpha with Sensex, BSE, and all. So monthly, I'll keep checking how I am performing vis-a-vis market. So this is how the performance is tracked. Somehow this month, the performance was not great because there is a lot of decline in mid cap and small cap, and also I understand the stocks which I have purchased, they are on, losing front. And now I am making some changes to my portfolio. I just have changed my, portfolio into some more, change from PSU and banking sector heavy portfolio to other portfolio where the currently some companies are doing well. Like I have added HBL Life or HBL Energy. Then I have added Skipper. Now I'm going to add. Few days back I have added some Tata Group companies. So shortly into Reliance. So that is how I'm making changes dynamically. So with these changes, there will be some sort of gain because the churn is always there in when it comes to market indexes. Whereas we tend to fix on to certain things. And though I will not sell any of these companies, but yeah, fresh investment will not be into those areas which I feel they are already overvalued. So this is how I go to, and then this is my US portfolio. US portfolio also, yeah, yeah. Today only I just made a assessment. It is fairly doing well compared to Indian stocks because this is the area where I am now focusing on, not unlike Indian stocks where I actively stopped trading since February 2024. So after that, whatever value additions is into other areas, while yes, the existing lot naturally, since they are already, they are on the rooftop, naturally there will be a fall, but that I don't take it very negatively. Maybe in time to come, I may try to again reinvest into the same stocks once they fall steeply. I'm assuming some 30 to 50 percentage fall. So if the such a fall is there, naturally I'll again re-enter to take advantage. So this is how we have to strategize. Now coming back to this theory, then an investment advisor won't necessarily get flooded with calls from our clients when she is reported say 55 lakh gain in the client's portfolio, but you can bet that the phone will ring when it posts a $5,000 $500,000 loss. So naturally, a loss always appears larger than the gain of equal size. When it goes deep into your pockets, the value of the money changes. And then you need to understand one more thing. See, loss, whatever in stocks, if you have to lose, you lose only the capital. But when you have to gain, there is no limit to it. The upward limit is, there is no upward limit. Anything can be a possibility. So loss is limited, whereas gains is unlimited. So if you want to take that, advantage of gains, there are so many theories. In future to come, I'll also share you some of the slides. Otherwise, also I can just show you. I'll show you right now. See, there is a slide which gives you this particular slide. There is a research conducted by Professor William Salmon based on 468 investments over a period of 36 years from 1990 to 2006. What he understood is out of all those investments, only 4% of investment gave him over 10 times the profit, which gave the wealth to the tune of 61.7%. If you see the opposite side, especially this side, see here, 63.2 percentage of entire portfolio will be less than what you have invested. Many some companies would have given zero return also. So actually you would have that companies might have wiped out all your investments, and they contribute only through to 3.8 percentage of your overall value of your total portfolio. And then it is another 20 percentage within this 36 years, which have given you returns of 1x to 3x, and 8.7 percentage between 3x to 6x, whereas only 3.3 percentage giving you 6x to 10x. So this is in reality, this is how your uh, portfolio. This is basically venture capital portfolio. So this is how your entire portfolio outlook will be, and that will overall will give you around 15 to 16 percentage returns compounded over a long period of time, which is around 36 years. If we put in perspective, like I have showed you in the table in the past, today also I'll just show you. Say, let us assume it to be 15 percentage, constant growth, right? And then I'll show you how this will affect you. Uh, the so-called future value calculator. So you just click on future value calculator. You will get to have this kind of window. So use that. I think you can see it right now. So use that window. So this is there is some website called as calculator.net. So go for that website and click on this. So this window will pop up, assuming the 36 years is what we have seen right now. So 36 years, let us assume $1,000 or 1,000 rupees, whatever. The interest rate here in this case is 15 percentage, and you are not putting any money at the end of the year. So you just fixed your investment. You didn't make any churn. So we'll calculate what would it be like. So after 36 years, 1,000 worth of your investment, because of the power of compounding, it has compounded to 153x. So this is the return you will be getting if it compounds at the rate of 15%, in any case, it keeps on varying from, percentage wise. So if you see the last 1 year, the increase is 20x from 133 to 153, which is 20 times it has increased. So it is basically a reverse pyramid or exponential growth. If you see the graph, initially you don't see much of a difference because of 15 percentage growth. But if you keep on waiting for a longer period of time, the growth is exponential and it's huge. In any case, this is what attributes to Warren Buffett's wealth. He has invested since the age of 11. So he is now 94 years old. Let's assume he has put his money in for 84 years, right? And then let us see. So what will it be? 1000 he invested 84 years ago is now he is it is 125 million. So it is somewhere around 125,492x or 1,25,000x. So this is what is the multiples. That is the reason why Warren Buffett is one of the richest man on this earth, because he has started quite early in his life, whereas we don't know how far we will be living. Longer it is. Let us assume other investors usually typically they might say they have started in their early 20s until 68, 65. They are very, they continued with the investment even with the same 15 percentage compounded growth CAGR. So you will make it only 267x, whereas the other guy, he earned 265 million, 1000 times he has earned more. So this is the power of compounding. So you need to understand these concepts very clearly. If you want to be an investor, be a very long term investor. Only long term will fetch you returns. And for long term, the churn, the play, the kind of stocks you need to invest into totally, they keep on changing. And it is observed, I think, in the few past slides also I have explained in greater detail. The churn in the stocks, the churn, the churn is somewhere around 25 percentage every 10 years. That means in every decade, 25 percentage of stocks in a particular index will keep vanishing. We have seen quite a few stocks in Sensex. I'll just open that particular slide again for making it more clear. So I'll just show you how that Sensex keep churning. So also we need to have, understanding about these concepts, because if you don't understand them and there is no clarity with you, you will be subject to fooling by so many people. There are many people in the market to fool you and make your money go off. So there was a study which is conducted for around 3 decades and 3 decades and half, 98 to 2004. In 98, very few companies continued. One is Larsen and Toubro, which continued. Indian Hotels and Nestle is totally out after 1 decade. Then Colgate Palmolive is out in the next decade. They didn't re-enter again. Hindustan Unilever is one which continued for in all the 4 decades or 3.5 decades, Hindustan Unilever is there. Whereas Colgate Palmolive again re-entered in 2004, 24, right? Whereas ITC is still going strong. ITC and Hindustan Unilever. And when it comes to banking stocks, if you see Bajaj Holding, then ICICI, IDBI, SBI, out of them, uh, the latest entrant HDFC has entered in 2008, whereas ICICI was continuing. Still, it is continuing strong. ICICI is one which is continuing. SBI is another which is always there in this particular way. IDBI is totally lost. Now it's no more in the segment. Bajaj Holding and Investment has the similar story. And then the later entrant was Bajaj Finance with a powerful moat. They have re-entered. So if you see There's IT companies. IT companies also, Infosys happen to be always present in all, all the 4 decades, whereas MTNL is totally wiped out. Whereas NIIT is totally wiped out. Bharati Airtel re-entered. Bharati Airtel entering in 2008, it continued because of a strong telecom story. Reliance Communications is totally out from the market. Then Satyam Computers is now replaced with Tech Mahindra, which later re-entered in the last, like in this, decade. But TCS, yes, TCS is continuing. It's going very strong. Then HCL has started in the previous 2018 and 2024. You find it that particular decade. So this is the story. If you see, you can understand. Whereas FMCG is totally lost. Sorry, the so-called energy and metal. Uh, uh, the the churn was very high. Only 3 companies still continuing. One is NTPC, Power Grid, and Reliance. So if you keep on looking at the churn, many companies have, come and gone. So this is the reason why whenever you are putting a long-term bet, you need to understand these dynamics and accordingly you have to take your own decisions. So it's always better to have a good amount of understanding because ultimately money matters. If you don't at all understand the dynamics of the market, better don't put money into it, and instead you use it for, or rather put money into uh, the so-called safer bets like fixed deposits or some mutual funds. Equities are doing well, both mid cap and small cap, but they are not all funds are doing well. So you have to be very careful in selecting those kind of funds. So then prospect theory also explains why investors hold on to losing stocks. People often take more risks to avoid losses than realize gains. For this reason, investors unwillingly remain in risky stock position, holding price will bound back, which we already discussed. And then gamblers on a losing streak will behave in a similar fashion, doubling up bets in a bid to recoup what's already lost. Yes, so despite our rational desire to get a return for the risks we take, we tend to take something we own higher than the price we would normally be prepared to pay for it. So naturally, see, when you see the behavior of gamblers, gambling is akin to, stock markets. Uh, if you don't apply logic and rationality, no? So most for majority of the investors, it is a medium to recoup losses, And suppose if you have lost say 10 lakh rupees, you tend to up your ante, you tend to increase your stakes and wanted to recoup that particular loss. At the same time, you want to regain that or even more. So in order to regain more, you tend to put bigger bets. And consistently, if you keep losing on, still you want to make it. You know that human nature is like, you want to take risk to ensure that you get some, lottery kind of a thing whereby you will make it. Majority of the people they don't make. And once they mess up with their entire wealth, and also some people they even go for loans or debt, finally entering into the market they lose big, and finally they lose faith in the market, irrespective whether market gives them or market is doing well. They will never have any faith and they don't put money into it. So avoid such kind of behavior. Loss aversion theory points out to another reason why investors might choose to hold their losers and sell their winners. I think this I have discussed many a time. They believe that today's loser may soon outperform today's winners, and investors often make mistake of chasing market action by investing in stocks or funds which garner more attention. Research shows money flows into high performance mutual funds more rapidly than money flows out from the funds that are underperforming. So naturally, there will be a crowding effect when there is a heavy media effect attention. That means the prices have peaked. I think the last time also I have explained this very clearly with the help of a graph. I'll just once again I show you. So you tend to always remember these things. These fundamentals are very, very important. If you don't understand the fundamentals, it is you who is going to lose and no one to blame except for you. So be clear with your fundamentals. Otherwise, you will lose. So actually, this is one more interesting graph, which if a 100 rupees invested in 1990 till 2022, that means a period of somewhere around 32 years. So the amount, if you hold cash means nothing but you are holding it in bank, which will give you a compounded growth of interest of 7.1 percentage based on what is today, with a standard deviation of 0.6 percentage, whereas there is no drawdown. Drawdown means the collapse or crash. Welcome back, guys, to the second part of 11th session, sorry, 10th session of wealth management for working professionals. So now we have finished one more part related to behavioral finance. Now coming to investor overconfidence, people generally rate themselves as being above average in their abilities. They also overestimate the precision and veracity of the knowledge, as well as the perceived superiority of their knowledge relative to others. So many investors believe they can consistently time the market, but in reality, there is overwhelming evidence that proves otherwise. Overconfidence results in excess trades and with trading costs denting profits. So naturally, because of your overconfidence, assuming that you are more intelligent or your ability is superior or better than others, better than the average, you tend to overestimate your own understanding about a company, about stock market, and about the timing. So what you tend to do is you mistakenly make into it, and you make so many mistakes to ensure to prove that you are better than the average. You tend to do excess trading, and excess trading we tend to do because we tend to make mistakes or make over assessment about our own abilities. So that will naturally dent your profits, and also you pay more taxes, you pay more expenses like brokerage or STT. Recently there is an increase about 33 percentage when it comes to short-term capital gains and about 25 percentage when it comes to long-term capital gains. So this will affect your the so-called you can say the profits which you would be otherwise generating. So better to stick very long. Long means 10 years and above. So again, you have to be very smart. As I said, the market keeps on churning. The churn is the rate at which the good ones fall bad, and then the so-called mediocre guys performing better. So there is always a churn within the market. You should time your market or your investment according to that. And again, as I said, always understand the product, its life cycle, the technology and its life cycle, the company and its life cycle, and also the industry and its life cycle. These are very, very paramount to understand. Apart from that, we will be dealing with the so-called, the economic modes, or so-called how or why some companies remain or have sustained competitive advantage. We will be discussing that topic in future to come. That will be a very interesting area. It is very vast. So many factors are there which I'll be covering, and that will be very, very long and lengthy. And keep on ready. I think this series will run for maybe around 70 to 80 or even more. So probably another 100. This is what I'm thinking. I may make minimum 200 to 300 hours of recording about this particular area. And next comes is your social factors. See, while much of behavioral economics has been driven by cognitive psychology, economic psychology indicates that there are also supra-individual forces at work that drive investor behavior. For example, people are more conservative when making investment decisions on behalf of close others. Most investors become even more conservative with investments made in accounts that had culturally silent label such as retirement, college savings. Other research is now looking at how social relations and larger structures like culture play on financial decisions. This shows that investor behavior is driven not only by psychology but also by psychosocial factors. So, for social factors, like, as we said, as an individual, we tend to behave and make use of funds in a totally different way compared to when we tend to make decisions for others. When it comes to others or the society at large, there comes your accountability to people. At the same time, nobody want to risk their reputation, the reputation of squandering somebody's wealth. So people, because it is other people's money and they put trust in your ability to manage funds, we tend to be very, 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 very conservative, ultra conservative. In being ultra conservative, we tend to only invest into something which give a assured rate of returns. That is the reason why you find most of the society funds are put into FDRs, because FDR is pretty regular, pretty decent, it is known, and also we know whenever there is any kind of requirement, we tend to offload such kind of a structure and then put money into. And same with retirement plans. Whenever you are making a retirement plan, you tend to put some into some assets that give you assured rate of returns. So like, again, monthly rentals or annual interest. Like, that is the reason why REITs have become REIT, Real Estate Investment Trust. These funds have become quite popular because they tend to invest into some assets that give, monthly rentals like commercial properties in good cities. So they give a decent returns of 10 to 12 percentage depending on the location and also the kind of property they own. So REITs have become highly popular and successful. Any persons who are thinking in terms of retirement plans, this is one of the option which they can look at. Apart from the other plethora of things which are available like debt mutual fund or your so-called even equity growth funds, equity growth, instead of growth, you put it into dividend, equity dividends fund, so that regularly you get a stream of income that can make ensure that your lifestyle is not compromised on or the cost of living is not much affected. So this is in nutshell why people behave different when it comes to their own individual investment and investments of others or some close relatives. And then the third is related to some society or some clubs. So naturally, this is what is being shown. So people tend to be very aversive towards any kind of risks. Now, the question is irrational behavior a norm or an exception? So, this is haunting, or rather, this is the question which is being asked by behavioral scientists. And if you see all the economics literature or theory, they all talk about rational man or man taking rational decisions. This happened to be an underlying assumption. You take any kind of economic theory, it will be the same. See, the best example in when it comes to the area of investment, it is efficient market hypothesis. In the efficient market hypothesis, it is assumed that the investors, whosoever, the community of investors who are investing into stocks or into investments, they tend to be, taking a rational decisions based on information which is available within the market. And according to that market information, they base their opinions, views, and future uh, goals or even planning based on such kind of information. And because that particular a smart investors happen to have taken got all the information, and the price discovery happened to be the best, so nobody can beat the market. If anybody tend to beat market, it is only ephemeral or temporary or by chance. So they also said that if you teach gorillas how to type or chimpanzees to type, somebody may type entire Bible, but that is only by chance. So no one can beat the markets. This is it. And indeed, it is proven true also. 95 to almost 99% of the cases, if you see the investors, even the investor community, including mutual fund managers, you find uh, in whatever them to be successful only in a certain areas, or very few among that investor community or the so-called wealth managers, very few are successful. To be very very successful, you need to understand the behavior of the markets, and that is because that is an anomaly. Only few people happen to understand the market properly. This behavior is a norm. It is not an anomaly or an exception. So, Dr. Carolyn McLagan, founder and director of financial planning at Life Planning Partners Incorporated, he said it's understated to say that financial health affects mental and physical health and vice versa. It's just a circular thing that happens. When people are under stress because of finances, they release chemicals called as catecholamines. And uh, I think people have heard of things like epinephrine and the stuff like that, and then that kind of put to your whole body on fire. So that affects your mental health, affects your ability to think. It affects your physical health, wears out, makes you tired. You makes you can't you can't sleep, and once you can't sleep, you start to have bad behaviors to deal with, and that is the time when your cognitive abilities or the mental abilities or the mental faculty stop working properly. So because to be a very successful investor, you need to have a proper sleep, proper whatever the uh, body should be at proper rest, or you should be free from any kind of stress. Once you are stressed, as it is said, the catecholamines will be released in your body. That makes you saps of your entire mental energy. And at the same time, that will put your cognitive abilities to a lot of severe test and also stress. And that affects your way you behave or way you respond to the markets. Better don't do that. So that is the reason why you need to take adequate rest. And when it comes to investment decisions, never ever take any decision when you are not in a good mood, or you are mentally stressed or emotionally disturbed, or you didn't had a proper sleep, because sleep deprivation affects your entire behavior, entire body. So better avoid it. So as we again have discussed more about the so-called efficient market hypothesis, the theory that most overtly opposes behavioral finance is efficient market hypothesis, as we have discussed, which is associated with Eugene Fama and Ken French. Their theory that market prices efficiently incorporate all the available information depending on the premise that the investors are rational. And EMH proponents argue that the events like those dealt with in behavioral finance are just short-term anomalies or a chance results, and that over long term these anomalies disappear with a return to market efficiency. This is in nutshell about the theory. The theory says that, see, market is always efficient, and market behavior is always rational. They are not bound by any kind of herd mindset or anomalies. If at all any behavioral things are there, they are all temporary, and the markets get restored back to market efficiency. And hence, in the long run, it is highly efficient, and the markets are rational. But this is not a norm. This is only an anomaly, as we have discussed with all kind of discussions. And then a very important question most of the people ask: why do economic actors behave irrationally? What is the reason behind irrational? Several reasons are being proposed. Cognitive psychologists point to limitations in the human mind's ability to identify and process information. Psychology recognizes the role of human emotion subject to biases while making decisions. Most recently, economic psychologists, sociologists have identified social and cultural factors at work. Actually, see, when I started this session, in the introduction session itself, I have devoted fairly long amount of time on how religion will influence your wealth. So this I have discussed at length, and I need not reiterate again and again. Anybody who is interested, they can go back to session number 1 and session number 2. In session number 2 also, I have covered it at great length. So you can go through why, the religion or society or social factors, socio-cultural factors affect your decisions, decision making, because that influences you, that clogs your cognitive ability, that puts a kind of a cog on the wheel, or on your abilities to think. So that free thinking is totally inhibited. That is the reason why only certain communities like Jews, Parsis in India, it is like, Baniyas, Jains, only they could excel when it comes to the economic, or the so-called wealth management part. Whereas the rest of the people are totally guided and blinded by the so-called socio-cultural and religious factors. So you have to be very, very careful about that. And apart from that, most important, which I see, given the same thing and people are at same level, why do they fail? They fail because our human mind have certain limitations in terms of ability to identify and process information. Why do we don't process? We don't process information properly or the way it has to be. For that, there are many reasons. One is, number one, first and foremost reason is the education level. The level of education, then the level of cognitive abilities, ability to think freely, ability to understand, because it's not everybody's cup of tea. There is something called as IQ and EQ. IQ is generally determined as a human's intelligence or the ability to understand certain patterns, certain things, and observation is quite strong. It's not that every human being is equal. No, no human being is equal. They're all having certain, abilities or disabilities. and ability to process certain information. If say you may be brilliant, but if you don't understand English or what I am speaking, you may not be in a position to interpret the information. You may be the so-called you are not financially literate. You can't interpret the balance sheet, or you can't interpret the profit and loss account or the cash flow statement, or you don't understand the intricacies or interlinkages between each and every parameter within those statements. And if you don't go through the entire information related to the company's entire annual statement, naturally you are at a different level. You both are not at the same level. A person who has gone through, say, 10 years balance sheets or 10 years financial statement, a person who has just quickly gone through cursive glance of financial statements, there is a difference. They both process the information totally differently. They process it in a very way where they are good at. Many times, there are something, as I said, we always have confirmation biases. We have a halo effect, anchoring effect. We have that overconfidence bias, overreaction biases. So all these things act as a way in which things vary with same kind of people. And another thing is, many people, even otherwise they are highly able, they may not be interested. This may not be their cup of tea, or they may not think that having wealth or improving their finances is something which is important in their life. So it all matters, and many a times they may not have the adequate vocabulary to understand. Many a times, because they don't, there are gaps in the information or gaps in their understanding. The entire thing, whatever is being said or whatever is read, there will be always be a gap. Once that gap is created, that gap keep on increasing. If you don't bridge those gaps, and once the gap is established, it will be very, very difficult to understand, and you tend to make many mistakes. Once you have a blind spot in any particular thing, that that is an area where you are very vulnerable. And if you have ignored a very important point or a information, naturally your behavior is totally different, and you are bound to make a very wrong decision. So be very, very careful. So not that everybody will act rationally. No, not at all. People behave differently to different kind of things. And the importance they have given, as I said, there are socio-cultural, psychological, religious, all these factors combined together will make you or break your the way you think. And then, what does this mean for investors? By acting more or less irrational behavior, behavioral finance suggests that investors fall victim to a series of cognitive, emotional, and social forces that lead them to make suboptimal decisions and undermine their performance in the markets and elsewhere. So, this is it. So, this irrationality will affect your decision making due to a series of cognitive, emotional, and social forces that you know that will make you fall victim to. And then finally it will be reflected in the way you take your own decisions. And once you make a wrong decision, that's it, you are gone for life. And then many times one mistake may cost your entire wealth. And be very wary of very have one more thing into mind: always spread your risk. Don't put all your eggs in the same basket. You spread risk. Spread your entire wealth or money into various baskets with different varying risks and risk factors. That is very, very, very important. And then, okay. And by now, there is limitations of human behavior and decision making. People can make corrections or adjust them. It also implies the markets are not efficient as standard theory predicts, leaving room for savvy traders to take advantage of mispricing and earn a profit. Understand this? why I have taken at least 3 sessions is that understanding this particular behavioral finance is paramount for you to be successful as an investor. If you want to be a successful investor, you have to understand the behavior and the factors influencing your behavior. If you don't understand this, you are bound to commit mistakes. And these mistakes only you have to be blamed. And many a times it is human nature, we attribute our losses to some other extraneous or some other factors or somebody else to be blamed. So don't blame anybody, blame yourself for your mistakes. The faster you learn this, the better it is. And if you blame yourself for your own mistake, I think there is no person better than you because you tend to understand where you made a mistake. And once you know where you made a mistake, you should learn from your history and don't repeat it. Improve. Also understand why you made a mistake. It's not everybody's cup of tea to have that understanding about where did they mistake, because not everybody is capable of making a self assessment or analysis into what went wrong. It needs a kind of cognitive abilities, understanding, and come out of the so-called negative factors like socio-cultural and religious factors that influence your the decision making. And many a times people I have seen, they always tend to think that I can never be wrong, I'm always right. So if you have that attitude, you have to put it aside, because it's a matter of money, it hurts you more if you have such kind of an attitude. So finally leaving, you need to understand markets are not as efficient market hypothesis states or predicts. It is inefficient irrespective of whatever kind of a market. And the developing markets like India is more inefficient compared to a developed market like US or European or some other markets. So understand this and make your own assessments. So since market is not rational, so there is always a room and scope for making profit, because you can always take advantage of mispricing. Whenever there is a gap in information or gap in your assessments, that is the time when you need to take full advantage of. So finally, this psychology of focus investing. Focus investing is generally basically propounded by Warren Buffett. What he says is everything we have learned about psychology and investing comes together in the person called as Warren Buffett, which we have with this entire of the thing, which we have taken is from the life of Warren Buffett. And last few sessions, probably 7 or 8 sessions, are dedicated to him, his work, his principles, and the way he puts use all his skills as well as money into effect. So he puts faith in his own research than in luck. So always do your own research. Don't be, totally dictated by some luck, and don't think fortune favors brave. Your bravery don't favor you. It is your own research which will give you fortune, not the so-called taking ability to take risk. Never believe that. Believe in your own research. And then don't believe in somebody else's research. Don't trust somebody else's tips. You can take that tip. However, you have to make your own research before putting money into it. And then his actions derive from carefully thought out goals, and he is not swept, of course, by short term events. Actually, as I discussed in the past, Warren Buffett happened to be a contrarian. He always was not at all bothered about the short term events, short term fluctuations within the market. He is a man who always thought about a very long term goals. So if you see his entire so-called portfolio. He's holding those companies for many years. And there is a famous quote: if a company is outstanding, the period of holding is forever. So he made a mistake, as I said in the past, when he has taken one foolish decision in the initial stages, like in 12 or 13 years of age, 11, 12 years of age, when he sold off a particular stock. I don't exactly remember city something, So that particular stock went up 33 percentage. Later, immediately it crashed by around 40 percentage. And when it came up, bounced back, he sold it for some 10-20% profit. And later on, after 2-3 years, that has increased by another 200 to 300 percentage. Warren Buffett has calculated that he lost 5 years of his, wealth or prospective, that you can say opportunity cost is of his 5 years investments. After that day, he decided not to commit such kind of mistakes. And we all have to learn from it. He understands the true elements of risk and accepts the confident consequences with confidence. You need to have courage as well as conviction about your own, you know, actions. At the same time, you should know the consequences you are bound to face because of the decision you have taken. So it is always better to take a calculated and well thought and well researched risk rather than a risky, reckless risk. So you always, and then another thing is, because you have done a very carefully studied or researched decision, you should be willing to face consequences, even to take any economic losses if at all it happened to you. Not always, we are not gods that all the time we should be correct. So we can always be fault. And to err is human. So error, we are prone to making mistakes. So you accept that way. Don't self punish or don't tend to take it in a very negative way, or get yourself affected because of those decisions or bad decisions you have taken. You need to understand where you have committed a mistake, learn from it, and move on. Don't stick and don't become depressed, or don't tend to continue thinking about it for a very very long time to come. So come out of such kind of a thing. When 1,000 or millions of people make errors of judgment, the collective impact is to push the market in a destructive direction. This is what usually happens during a bull run. Bull run, people tend to be too, that is called as market exuberance, or you tend to be exuberant. You are not in a firm footing. Rather, you are flying off. You are thinking that everything is very well, doing excellently well. And this happens, this is because we tend to be human humans by nature are herd mentality or herd behavior. When we are of a herd behavior, naturally we tend to feel safe with what most of the people are doing. So we tend to go into it rather than taking a different path and making our own assessment and study. And then, so strong is the temptation to follow the crowd, accumulated bad judgment only compounds itself. So, because we tend to follow the crowd, if the crowd is at fault, we all make a mistake. And as Plato said, if 10 people say that a goat is a dog, people tend to believe it to be a dog. But because we tend to have a self doubt, and then we tend to believe others' beliefs. And instead, you don't believe what others say, you believe your own judgments. That judgment should be factual, well studied, well researched. It should not be blinded judgments or preconceived judgments or preconceived notions. Have an open mind. Being an investor, you have to be very open minded. You have to be risky as well. You have to be very rational. You should never be irrational. You should never be sentimental or emotional. In a turbulent sea of irrational behavior, the few who acts rationally may well be the only survivors. Rest all perish. So whatever the markets you see, it is all irrationality, irrational behavior. If you want to be successful, you should be rational and survive. Successful focused investors need a certain kind of temperament, which we have discussed in the previous sessions. You have to be calm, patient, and rational. And then the road is always bumpy, and knowing the right path to take is offer counter initiative, counterintuitive. And being you have to, you if you want to go in a right path, you have to go against the herd mentality, or what is the existing norm. You have to go, you have to challenge those norms. Only when you challenge, you find a particular right path, and that breakthrough path will give you unbounded wealth. If you want to have that unbounded wealth, you have to be a man different from that of crowd. If you can't be away from the crowd, then you can never be successful. The stock market's constant gyrations can be unsettling to investors and make them act in irrational ways, because market tend to be highly volatile. It will be like, depressive maniac. One time it will be, mad maniac in a good behavior. People tend to go crazy. And then that is the phase of bull run. That's the kind people are totally irrational. No, there is nothing, nothing rational about why that particular stock is going up. It is all irrationality which is crept in. And certain players, sometimes some players like some, the so-called uh, some operators, the stock operators, they tend to, because they wanted to make money, or their group want to make money, they tend to create a kind of a aura, or a kind of an illusion amongst the investing community that a particular stock is growing and it is going to do very well, and they will push the market prices beyond its real intrinsic value. And then people tend to madly purchase it because it's growing big. And as we have seen the tulip burst, that in good old days, maybe that is the first bubble which got burst somewhere in 17th century, when people in Netherlands, they all invested a huge amount of money into tulips and accumulated them. And finally, that bubble got burst. All the people whosoever put money into it, they lost money, because tulip cannot sustain such a high, unrealistic prices. So you need to understand it, and make your own assessment, make your own study. Always purchase stocks when they are at cheaper valuations or attractive valuations. A good company will always come with a premium. You need to identify what is attractive price. Attractive price is again an art that needs a lot of understanding, and there is no literature. It's all your assessment. If you assess it right, you tend to reap benefits out of it. And for that, you need to have very clear thinking, very clear thinking. And you need not have an outstanding excellent uh, you can say intelligence, or you need to be exceptionally brilliant in certain things. No, not needed. You need to be very, very disciplined. You need to have average intelligence. Average intelligence will do. You don't need to have exceptional intelligence to be a successful investor, but you need to be having certain kind of a temperament, as we have discussed. You have to be calm, you have to be patient, you have to be rational. These are the three things which are very essential. And you need to be on a lookout for those emotions, you know, for these emotions, that the emotions which we are talking, be it greed or fear or any others. Yeah, only these two factors play, especially in the stock markets. And be prepared to act sensibly even when your instincts may strongly call for the opposite behavior. But as we have learned, the future rewards focus investing significantly enough to warrant our strong effort. So you always have a focus investing, which we have already discussed. What does the focus investing mean? And we have discussed the behavioral finance part. And final takeaway, what does it mean? And then Buffett believes it is foolish to use short-term prices to judge companies' success. Instead, he lets his companies report their value to him by economic progress. Once a year, he checks several variables. What is that he keeps checking? There are three important variables he checks. One, return on the beginning of the shareholders' equity, change in operating margins, debt levels, expenditure needs, the company's cash generating ability. To be successful, you must be willing to have some thinking of your own. Unless you have your own thinking, don't expect that you will excel in making money. It is easy to follow somebody else, but it is very, very difficult to have your own thinking. But it is strongly suggested to have your own thinking rather than believing somebody's intelligence and somebody's judgment. But if you think for yourself, apply relatively simple methods. Have the courage of your convictions. You will greatly increase the chances of for your profit. See, if you simply believe in your own convictions, you are naturally going to make more money. This I have observed when during my initial stage of investments. Whenever I took my own decisions, I was very successful rather than following some investor or some tip or some information from the media, newspapers or some business channels. So this I have learned. Then I I have slowly came out from the influence by other factors to having my own convictions and taking my own calls. Nowadays, I don't, take any information from anybody, if at all, because we cannot insulate ourselves from so much of information coming and flooding. Whenever the information keeps coming, I do my own research and accordingly I invest. So, step one, what you should do, how do you do? What after all, after listening to the entire of the session, so-called, you know, series of Warren Buffett along with behavioral finance, how will you do? Step one, turn off turn off the market. Stock market is depressive maniac, as we have said. You don't follow it. You just simply ignore. You think as if they don't exist. Yet you have to purchase stocks in the market, but you should not be bothered by news related to how the stock markets are behaving. Number two, don't worry about the economy, which we have already said. I think in the previous slides also I have shown you, like I think in the session number 3 or so, I have shown you how this, GDP is not at all GDP and stock market as are not totally correlated. Once again, you see, this is the performance from 1997 June to 2019 June. All these, this coffee color or light coffee color shades, these are the things when markets behaved contra to GDP performance. So nowadays, see, initially it was more or less, the GDP story and the stock performance was in sync. But if you see this particular thing of late, it is all, mostly it is contrary to what the markets are. So don't trust that you will time the market based on the GDP performance, and the so-called stock performance or stock market performance has no similarity. Understand? So better understand this principle and better avoid. So step number three, buy a business, not a stock. Whenever you are buying any stock, you are buying a business, not a piece of stock which where you can sell for a price and make money. No, you are trying to purchase businesses. Businesses, when you are purchasing a business, you tend to put a lot of due diligence. It may be legal, financial, all kind of due diligence. Only then you tend to purchase a particular dish. You can say a stock. Number four is manage your portfolio of business. How to manage that will be taught maybe in after we finish a lot of theory. Lot of theory is still to be covered. So for today, this much. So we will continue in the next the 11th session. So till then, goodbye everybody. Thank you very much for your patient hearing.